Welcome to the Explainer. Selling off a part of your company, it can cost millions, even billions, in advisory fees alone. But what if you could claim back the tax on those costs? Today, we're diving into a landmark European court case that hinged on that very question, and it has huge implications for how businesses everywhere structure their deal.
So, you see the question here? Looks simple, right? But the answer? Oh, it's way more complex than you'd think. When the huge industrial group SKF decided to sell off one of its subsidiaries, it ran smack into this exact dilemma. Could they actually deduct the VAT on millions and millions in deal costs? The court's answer would end up setting a major new precedent.
Okay, so before the court could even touch the whole cost issue, they had to go back to basics and ask an even more fundamental question. For VAT purposes, does selling shares even count as a business activity in the first place? And it turns out, the answer all boils down to the difference between just being a passive investor and being an active manager.
And here's the line in the sand that the court drew. It's super clear. If you're just passively holding and selling shares, like a typical investor would, the court says that's outside the scope of that. But if you're a parent company like SKF and you're actively managing your subsidiaries, maybe you're providing them with services like IT or marketing and charging them a fee, well, you've crossed the line. That active involvement makes the share sale part of your core economic activity.
And boom, that's the key right there. Because SKF Trans was providing these taxable services to its subsidiaries, its role wasn't just passive ownership. The court ruled that selling those shares was, and I'm quoting here, a direct, permanent, and necessary extension of its main business. So the first hurdle is cleared. For SKF, this sale is now officially in the game, inside the world of VAT.
Okay, so we've established one thing. For an active parent company, selling a subsidiary is an economic activity. But just when you think you've got it all figured out, the story takes this really interesting twist.
And here it is. Even though the sale is an economic activity, it's also exempt from VAT. This means you don't actually charge VAT on the final sales price. Now, I know what you're thinking. Wait, that sounds like a total contradiction. But stick with me, because this distinction between being in scope and being exempt is absolutely critical. So why on earth is it exempt? Well, the reason is actually baked right into EU law. The VAT directive basically carves out a special exception for financial transactions, including trading shares. And the court clarified that this isn't just for professional stockbrokers. No, it applies to any transaction that, as it says here, formally alters the legal and financial situation between the parties involved. And selling a company? Yeah, that definitely does the trick.
This brings us right to the heart of the case, and honestly, it's the most important takeaway for any business listening. If the sale itself is exempt from VAT, how in the world can you possibly claim back the VAT you paid on the millions in costs to make that sale happen?
This is the exact paradox the court had to solve. Normally, if your costs are tied to a sale that's exempt from VAT, you can't deduct anything. It's a dead end, game over. But the court didn't stop there. Instead, it laid out this brilliant logical test to find a path forward.
And they call it the direct and immediate link test. The court forces you to ask, what is this cost really for? If a cost is baked directly into the share price, think of it as a component of the sale itself, then it's linked to that exempt transaction. And sorry, you can't deduct the VAT. But if the cost is really for the benefit of your entire ongoing business, let's say you're selling a division to raise cash to strengthen your other profitable operations, then it's a general overhead. And for general overheads, the VAT is deductible.
This simple table right here, it transforms the whole issue. It goes from being some complicated legal puzzle to a practical accounting one. It's all about cost allocation. That means the very same advisory fee could be non-deductible if it's booked as a cost of the sale, but fully deductible if you can justify it as a cost of reorganizing and funding the future of the entire business group. The stakes are just massive.
And this is a really important point. The European court provided the framework, but not a universal yes or no answer. It basically tossed the final decision back to the national courts. It said, in essence, look, here is the test. Now you apply it to the specific facts of the case that's in front of you.
So, how did the court justify this really clever distinction?
Well, its entire ruling is built on two fundamental principles of the VAT system that make the whole thing logically consistent.
First up is something called fiscal neutrality. At its core, this just means the tax system has to be fair and consistent. You shouldn't get a different tax outcome for two very similar business activities. The court said it would be completely unfair to allow deductions for a passive investor's sale, but then block them for an active manager's sale, especially when both might be using the proceeds to fund their wider business. It's all about creating a level playing field.
The court also cleared up a really practical question that businesses face all the time. What happens if you don't sell all the shares in one big bang? Does selling them off in stages change the tax treatment?
And the court's answer was a loud and clear no. And this reinforces the second key principle, legal certainty. The rules need to be predictable. The tax outcome is based on the fundamental nature of the deal, not on how many chunks you decide to sell it in. Businesses absolutely need that consistency to be able to plan effectively. So let's tie all of this together. The SKF ruling gives us a clear roadmap. If you actively manage a subsidiary, selling it becomes an economic activity. And while that sale itself is exempt from VAT, you can still deduct the VAT on your deal costs, but only if you can prove those costs are general overheads that benefit your entire taxable business. It all comes right back down to that direct and immediate link test.
In the end, this landmark case doesn't just hand you a simple answer. What it does is give you a powerful framework and the right questions to ask of your own business. So the final question is for you. Are your deal costs truly just part of the sale, or are they an investment in the future of your entire operation? How you answer that, and more importantly, how you document it, could have a multi-million-dollar impact on your bottom line.